Philip, you and the HDA analyst team have just published an extensive commissioned research report on Gabriel. This is a new product for the HDA. Can you explain a little bit about that product?
Yeah, thank you, Michael. Yeah, so the extensive report is new for HC Andersen Capital. As you mentioned, people familiar with our products might know our one pages, which are more of a overview of the company and touch on the key investment reasons and the key investment risks, as well as the company's own guidance and some simple valuation multiples. But the extensive reports, these are really a deep dive project where we've spent several months analyzing the company and data around the industry. We've conducted multiple interviews, including with the management, and this has guided our financial model, giving a much more detailed valuation. So this process has also been supported by our partners up in Finland, who have 15 years of equity research experience and currently cover 85 to 90% of the Finnish stock market. And collectively, we've now produced this new product, which is called our extensive report.
Perfect. And Gabriel, probably a lot of people have actually been in touch with that if they have been in an office environment, but probably don't know what Gabriel is. So can you talk a little bit what they do and how do they differentiate them from the competitors?
Yeah, exactly. So Gabriel actually were founded in 1851, so a huge history. They began in northern Denmark, in Aalborg, as a fabrics producer. And they've now become a specialist player within the high performance fabrics for upholstery. So within the furniture market, both for commercial and for residential. In 2022-23, they had a revenue split of 75% in Europe, 20% in America, and 5% in Asia. And that's come as they've been growing internationally. And that's still part of their strategy moving forward. But to go a little bit more into the company and the different business units which they have, you can say that now they're a specialized player, but that fabrics is still at the core of the business, where they develop these high performance fabrics. They produce them primarily in Eastern Europe, and then they sell the fabrics to global clients, including some of the leading names within the furniture market, such as Miller Knoll and Steelcase. But they're not just a furniture fabrics producer anymore. They also have other business units, which is part of what sets them apart from their direct competitors. So they have 3 additional business units. One of them is Fernmaster, and this is an outsourced production capability. So here they work with clients to design new products and then also fully outsource the production of these products from the facilities in Eastern Europe and now also in Mexico. And you can say this was born from the idea that some clients wanted Gabriel to perform the upholstery of their fabrics on the products themselves, and now it exists as a fully outsourced furniture solution. The next of their business units is called Sample Master. This works on the sales side of the value chain, where they help produce promotional materials. So this business unit works with Gabriel itself, but also external clients to produce these sample kits, but also to support in the design and the production of prototypes, and then all of the logistics around sales activities. Next, they have a business unit called Screen Solutions, which really focuses on the new needs for office spaces, given the hybrid work that we're returning to following COVID-19. So they work with acoustic solutions such as fabric coated paneling for separating desks. They have paneling for walls and for ceilings of offices to absorb sound, and they also have a design team which helps furniture producers that are wanting to create new furniture for this hybrid workspace, this new office environment, which all encompass these more sort of private spaces and sound absorbing areas for collaborative work. So you can say that overall, the company at its core still produces furniture fabrics, but it's now become a full value chain company, starting from the design of products to the production of furniture to support of the sales, and has become a full value partner for many of its clients.
Let's take a little bit look at the market. I guess this sounds like a COVID hit company. So what about the market, and is there any outlook for any changes in the market condition? It's always something that could trigger investors' interest.
Yeah, so as you mentioned, Gabriel, and the wider furniture market has been on a big up and then down cycle since COVID-19. It started during lockdowns and the global stimulus programs with low interest rates, where the demand for durable goods, and particularly Gabriel and particularly furniture products, really skyrocketed. And this was also seen in Gabriel's numbers with a record year in 2020/2021. And since interest rates have risen and due to inflation, this has really reversed, and there's been almost record low levels of activity in the real estate markets, in housing markets, and this has hit the demand for furniture globally. So there's been an up and downturn, and what we're seeing in the market now is that we believe this downturn is starting to bottom out and move in the positive direction again.
So you are seeing some leading indicators that could show that.
Yeah, exactly. So we're seeing that housing market activity is starting to at least bottom out, but actually also improve in places. We're also seeing that, for example, Gabriel itself upgraded its guidance in connection with its Q2, and this has also been seen when we're monitoring some of its listed clients, where their earnings have also beaten expectations recently, and we're just starting to see these leading indicators point in the right direction. We've also seen that some other cyclical Danish companies have already rebounded, and that Gabriel hasn't been part of this story yet, but that overall this falling inflation and potentially coming down of interest rates is starting to actually take effect in the market.
And then let's look a little bit about the drivers and maybe the risk you should look out for as an investor, and you as an analyst at this market. What are the main drivers for this market, and what are the main risks?
Great question. So one thing we're paying close attention to is the Gabriel's numbers itself. We're seeing this positive rate of change in the revenue numbers, and that's something that we're going to be looking out for, to see that this rebound, this turnaround story is coming to fruition as we expect. In the market more generally, there's still uncertainty. This bottoming out is where we think we are, but there could be a reversal again to the downside. So we're definitely paying attention to the wider macro conditions, inflation, interest rates, housing and real estate market activities. We're paying attention to the numbers from Gabriel's customers and peers, and we're trying to assess that our thesis of a turnaround is really coming to fruition.
And looking on a longer term, a structural driver, screen solutions and hybrid workplaces, and that our office needs to look at a certain way when we do the hybrid work and return to office. Is that also something customers or Gabriel mentioned as a potential driver that can kind of come on top of the macro?
Yeah, exactly. So as you say, that's part of why we think that it can rebound, and especially as the macro ties into this story that companies are wanting to bring people back to the office, and that's been a challenge since people have had the option to work from home. So research is suggesting that offices need to redesign, and many people probably have seen this in their own places of work, but we need new places where people can have time to focus privately, different areas of collaboration where you don't disturb the rest of the office, and places to take Teams calls. So the actual requirements of office furniture have changed quite significantly since COVID-19, and this is part of this story, that there's going to be greater investment needs for furniture, and that's going to, of course, positively affect the need for furniture fabrics and in turn the demand for Gabriel's products.
How have you built all this into your estimates? You know, a rough, is it a high growth story, medium growth story in the middle term? How do you build in those risks, and how do you kind of match them with their own expectations or own long-term goals?
Yeah, of course, our model is built on forward-looking assumptions from us, and while there's uncertainty surrounding these, we feel that we've taken a moderate approach. We're expecting revenues to peak at around 10%, which is significantly below the company's own target of 15% annualized revenue growth, and also a good step behind what we've seen historically, where from around 2014, the company's grown at a compound annual rate of around 14%. And part of why we think that this growth rate is going to be below what we've seen historically and the own targets is because Gabriel does have a good amount of debt on its balance sheet at the moment. So we feel that there's going to be a lower ability to invest in CapEx and to invest in this accelerated growth. However, what we're also seeing is a level of underutilization in the production capacity at the moment. So we think that even without much investment, the company can come back to at least around its high water mark from 2021. And we're expecting a moderate rebound up to that point, but that the company can pay down debt and improve its gearing ratio during this period to then reach up to this around 10% growth during its peak period.
Also, and margin improvements also, I guess it must be a low cyclical margins they have right now.
Exactly, yes. So as the revenue comes up, we expect a margin rebound as well. And we expect this at its peak to be at around 10%, which is in line with what we've seen during previous cycle highs. And then towards our terminal period, we're expecting margins to fall to around 7.5%, which is actually around the level of its 20-year average, and for growth to trend towards a terminal rate of 2% in line with just broader global growth. So,
but let's conclude on all this and put it into your target and your recommendation on this year.
Great question. And overall, we've assessed an accumulate rating for this share as we see a positive risk reward for the coming 12 to 18 months. This is supported both by multiples and our DCF analysis. So I'll go into more detail now. On the short term, multiples are high for this name, and that's a result of these low cyclical earnings. But when we zoom out a little and take in our growth forecast into the picture, we see that for next year, which is 2024-25, Gabriel trades at around 17 times EV/EBIT, which is slightly below its historical range, but more importantly, it's about in line with where we're seeing the other cyclical Danish names. But then zooming further out, we actually see a price earnings of around 9 to 10 for 2025, 2026, which we believe is attractive based on historical levels and other multiples we're seeing in the market. However, we don't place too much weight on the multiples themselves, especially because there's not a direct listed peer for Gabriel in the market. So we do put more focus on our DCF model. We've gone through the assumptions already, but the DCF output actually has a value per share of 307 Danish kroner. And our recommendation is a little under that to adjust for the fact there is uncertainty in the market and in some of our assumptions. Investors should, of course, be aware that this model is built on assumptions, but we think that they're moderate, and we've therefore put our price target at around 295 krona per share.